We used to call it the Magnificent Seven and then the Super Six. Now it's the Fantastic Four, but there's only one stock to rule them all. That's right, NVIDIA. But maybe this dynamic is starting to change as second derivative AI plays are starting to take part in AI mania. And being on the right side of this trade will give you outsized returns in the year ahead. So what does that mean and how will it affect the broad market? Let's talk about it. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit that notification bell. Let's get into it. What a rebound from yesterday, except in Apple. Apple is looking a little bit sick. We're going to talk about that chart a little later, but we saw strong buy-side momentum here in technology, particularly software. And I also want to talk about Uber. We're going to talk about them. Really interesting to see the price action we're getting in Uber at the moment. And in my ETF portfolio, about 7% of my total assets is in Uber. So to see what Uber is doing and what software as a whole is doing is kind of crazy. We spoke about this very briefly in one of my videos about 2 weeks ago. I said software is actually going through like a multiple expansion phase. You know, it was a second derivative of AI and they were next in line. You know, it was really the big boys first, semiconductors, software's next, and then everybody else is going to come as a result. And I think we're getting sort of the AI mania that we haven't quite seen in software that we did get in semiconductors. We're probably getting in software right now. Now, looking at the rest of the market, it was actually quite great breadth across the board. You know, it really just was a rebound from yesterday. And to be honest, if you didn't make money in this market today, what are you really doing? What are you invested in? Probably all consumer defensives because they were pretty red. And even then, if you're in Costco, right, probably still up on the day. But all in all, a pretty green day, except in consumer defensives and here in energy, which was largely flat for the day. It wasn't even red per se. So this is a trade I gave you guys a couple of weeks ago, and essentially when the trailing quarter October 27th to Jan 27th is greater than 5%, what can we return from Jan 27th to Feb 15th? So I gave this trade 2 to 3 days in advance and I said, you know, we have all the parameters set for this trade to take place. It has returned 2.24% in this period right here, despite 2 down days of 1% or more. So it has been a volatile trading period. That being said, had you put money in it, you would have been up about 150 points, and that's very notable. And this trade officially goes, if we do end up in the green tomorrow, which is highly likely we will, 22 and 5, with 1% moves being 18 from 3 and 3% moves being 9 from 3. So very positive stats right here. Very good trade that all of us took, and it's great to see these results. Now, this is the S&P 500. A couple of things I want to note. Firstly, the advanced decline line moving up exactly as the S&P 500 is moving up. That's exactly what you want to see in both the market and the constituents inside the index. Now, zooming into actual price action on the day, a couple of very notable things. This blue line right here, that is actually the gamma flip zone. This line right there. So buyers came in at the gamma flip zone yesterday, bought all the way up and continued to buy throughout most of the day. But if we actually zoom in a little further, what we did see was that we opened right here. Bears did try to take us lower by this long wick. Bulls found value and took us all the way up to the open, to the high of the day, and we pretty much closed at the high of the day. That's very bullish when you see this, and do expect the momentum to continue because this actually looks very bullish. There is also an overhead gap on the upper end in the S&P 500, as well as this huge tail wick right here. However, if you look at the weekly chart, we are still red for the week, but we are officially in the upper third of the candle, and that's very bullish. We do want to see follow through tomorrow in not just the S&P 500, but in all the other indices. Now, looking at the actual 5-minute chart in the S&P 500, you can see this is Monday's gap we're trying to close. This is where dip buyers came in. This is where we opened the day in the S&P 500, and you can see that sellers did take us down in the morning, and then at the close yesterday, buyers did find value, took us a lot higher. And what we do want to see tomorrow is really to go ahead and close these highs right here. And remember what I've been telling you guys throughout the gamma situation, this 49.20 level right here, unless we actually go ahead and break below that, close below that, and have some price discovery below that, we're in a positive gamma environment and all dips are to be bought. It all changes below the gamma flip zone, but until that changes, we're still in very constructive bullish price action, and nothing in the tape tells us that's going to change. Now, it's actually the exact same situation for the NASDAQ, as you can see right here. Now, looking at the majors, IWM, small caps, they were the best performing sectors today. Look at IWO, small cap growth, even outperforming the Russell 2000 as a whole. And mid caps in third place, followed by the NASDAQ, the broad market, and then the S&P 500. And really good to see the RSP outperforming the S&P 500 throughout this entire time period, both on the upside and the downside. So market breadth is definitely improving, especially in the S&P 500, as well as the small caps, but they were down like 4% plus yesterday. So to see this rebound is not any surprise. That being said, had you actually bought the lows, you'd actually be up about 3.5% in the IWM if you bought the lows from yesterday. What we do want to see now is continuation of this momentum. There's still gaps to be closed in IWM, NASDAQ, RSP, S&P 500, mid caps as well. So we want to go close those gaps, recapture those highs, then we can continue on the uptrend. But we want to see follow through after today's price action. And things were looking a little bit weak, you could see here, for mid caps, for small caps towards the end of day. But it was expiration today, and we are getting a lot of the gamma rolling off the tape as well. So to see weakness from tomorrow onward in the indices is completely normal, well within seasonality. And here's market breadth. So you can see in the S&P 500, 386 gainers, 113 losers. This is great breadth, by the way. Anytime you have more than 300 gainers, very great breadth. It was sort of like the big boys up here as well. Look at NVIDIA, look at Meta, look at INTU, but all in all, great breadth, especially when the big boys are here. You then do get these like great rallies, 1%, plus in a single day. Now let's talk earnings. We had a volatile day of earnings. If you didn't see lift after hours, go ahead and look at that chart and see what happened there. They added an extra zero into one of their columns in their financial statements. Stock was up 50%, then pared all gains after their redaction of that. Oxy and Cisco, pretty average earnings, nothing to go off. Very average earnings, guys, today. We're not really going to cover any of it. What we are going to cover, though, is the earnings scorecard. So I've gotten all the key data into right here, and we can see that revenue growth for the S&P 500, this is blended earnings versus actual earnings growth, and S&P 500 revenue increasing 3.4% year over year, 4.8% excluding energy. Earnings, we actually saw an uptick in both the S&P 500 and the ex-energy segment. It was 9% on Monday. We're sitting at 9.2% and 12.7% ex-energy. Double-digit earnings growth right here, and everything still remains super positive on the earnings front. And this is why all dips in the market should be bought. All drawdowns should be looked at as opportunities for higher price action into the 5,000 area. Now, diving into earnings specifically, what we're seeing is that earnings expectations have been moving sideways for the S&P 7, the Magnificent 7, and down for the S&P 493. However, what we are starting to see is an uptick in the 493, and we got BOFA's latest data right here. Now, we could actually see that we're expecting 0% for the first quarter 2024 in the S&P excluding the Magnificent 7, the 493. This dark blue one is the Magnificent 7. We are expecting 35% growth in the Mag 7, 20% growth in the second quarter of 2024. In the same quarter, though, the 493 is going to report 8% growth and 8% growth in the third quarter 2024 in these two quarters. And then in the fourth quarter 2024, 20% for the 493 versus 12% for the Magnificent 7. And this is where we get those like long bull market rallies, when we see broad-based participation, not just in the price movements day to day on the charts, but also in the fundamentals, when the macro backdrop is conducive to a strong earnings environment. And that just means strong economy, high GDP, strong consumer, and that's what we're seeing right now. So the Magnificent 7 is going to hold us together up until here, and then the Magnificent 7 and the 493 is going to take us into 2025. And if we can get like these earnings in the 493 for 2025 as well, that is going to be some serious tailwind for stocks, and we could definitely see 6,000 by the end of 2025. Now, I showed you guys this chart yesterday, and a lot of you had a lot of comments in the comment section saying it doesn't matter what this looks like, NVIDIA is still overvalued. Well, I have some data, and let's actually have a look at it. So this right here is the Magnificent 7, and this is the 5 largest stocks in the year 2000. We're going to call these the Fantastic 5. Right? So they are Microsoft, Cisco, General Electric, Intel, ExxonMobil. So you got a couple of tech companies, a semiconductor, an oil company, and then General Electric, which is like a bank and engine manufacturer, aerospace company, car manufacturer. I don't know. You could call them a whole bunch of things. But yeah, these are the Fantastic 5. These are the Magnificent 7, and only one of them is still in there, Microsoft. But you know what? We got in the Magnificent 7, we got a couple of tech companies, a car manufacturer, one semiconductor companies, and a couple of communication companies, as well as Amazon, which is really a discretionary company. Now, let's actually compare the metrics. So price to earnings. The Fantastic 5, 43x. 2025 PE for the Mag 7, 27x. Big difference right there. Sales compounded annual growth 1999 to 2001. What are we expecting? 16%. Okay, what was the realized growth? 8. What is it for the Magnificent 7? 12%. What are we going to realize? I'm willing to bet 12 or 13. Earnings have been great, guys. Earnings have been fantastic, excluding Tesla. Tesla's been the outlier. Earnings yield gap versus the 10-year treasury yield, 370 basis points, 28 basis points for the Mag 7. Look at EV to sales, 11x for the Fantastic 5, 6x for the Magnificent 7. 3-year investment growth ratio, so essentially CapEx, 26%, 60% for the Mag 7. And not to mention, these companies were barely making money. Maybe Exxon was, GE was as well. Intel was in the works, gushing cash right now. I mean, like NVIDIA is growing earnings the most, but every single company on a year makes $100 billion in revenue or more. NVIDIA is going to do $80 billion in 2025. It's just starkly different if you compare the pair. So this vastly overvalued, this fairly valued in my personal opinion, especially because I do think that sales growth is going to realize higher than what is the consensus in my personal opinion. So I don't think the Mag 7 is overvalued. I think that these guys, I think they're just fairly valued right now. So yesterday I showed you guys this chart and we were looking at delinquencies, pretty much saying autos and credit card delinquencies were ticking up and it was going to get real bad if student loans ticked up. Well, I have some data that actually might go against this. This right here is just some data from BOFA and it says Exhibit 1. Periods of rising delinquencies have lasted an average of 12 to 13 quarters since 1991. So you can see here that we generally have 3 to 4 years of rising delinquencies and then a cool-off period. Rising delinquencies, cool-off period. Significantly rising delinquencies. This was the 2008 GFC and then significantly down. And now we're seeing delinquencies rise again here in 2001, still at historic low levels. Let's just keep that in mind. But these have been rising for at least 3 to 4 years now. This is March 2021. We're approaching March 2024. And so we probably have a couple more quarters of delinquencies rising before we generally do see them level off. And that's going to be really supportive for the economy as a whole. Delinquencies rising means the economy is weak. Delinquencies falling means the economy is generally strong. And you can see it right here and right here. And so in a couple of quarters, when a lot of this economic data is going to realize, I think a lot of these delinquencies are going to fall off. Now, I do understand we had a hot inflation print, but let's look at the data, the consumer, the GDP print. I spoke a lot about the consumer yesterday. Go watch yesterday's video. The economy is strong. The consumer is strong. GDP is well. Everything's tracking along well. The reason why we got a hot CPI print is because the economy is strong. Now, on the topic of yields and on the topic of rates and on the topic of the economy, the S&P 500 has broken away from its relationship with the yield. Now, in 2022, 2023, it followed yields very, very closely. You know, if yields were up, S&P 500 was down. If yields were down, S&P 500 was up. It's actually broken away from that relationship. Now, this is specifically for the S&P 500. The IWM, the Russell 2000, is a whole different bag of cats. You can see here that the S&P 500 was generally following the treasury yield curve up until it got into this position right here where it was S&P 500 up, yields up, and it just broke away from that yield. And that's really, really good because it does show that even if yields do rise, the S&P 500 can still move higher. And that's because I think a lot of people have realized that despite where rates are right now, stocks can still perform well and the economy can still chug along very, very well because this economy is very, very resilient. On the topic of rates, a slow pace of rate cuts has been very bullish for stocks. This is when the Fed has been slow to cut rates. This is when they've been fast to cut rates. And the reason why the Fed is fast to cut rates is because there's some underlying economic weakness. A recession is looming, whether it be in the economy as a whole, certain sectors, and they need to cut quickly to solve those issues and provide liquidity to the market. When the Fed is slow to cut rates, it means the macro environment is really, really good. And this is where we are right now. And when we are in a slow cutting cycle regime, we generally see stocks do very, very well, especially in the long term. You know, this is 1 year, 2 year, 3 years down the track. And this right here is simply proof that the further we push rate cuts out, the longer the Fed is going to take to implement those rate cuts. And that is very, very bullish because stocks just go on an absolute tear during a slow cutting cycle. Let's talk sectors. Now, the best performing sectors as it has been all year is semiconductors and technology. I think semiconductors actually pared all losses and they were actually up incredibly high at the start of the session. Then expiration went down and things did get a bit dicey for quite a number of stocks. But that being said, you know, technology still outperformed on the upside. But what we did see here was regional banks, metals, the biggest losers of the day, were also up in the upper end of the winners. What didn't do so well today was stable staples, energy, and GDX, XLRE, XLB, and XLU. That being said, a very positive day across the board. Guys, some major changes in the JEX. 49.45 is now the gamma flip zone. So this 49.20 area to 49.45 area, this is a very, very key level that we want to stay above. As long as we're above, these key levels right here in the S&P 500, we probably go higher, buy dips, sell rips. Something that's also a bit concerning is that 5,000 is now the call gamma strike. It's actually moved down, which goes to show in yesterday's sell-off, a lot of traders did just liquidate a lot of positions. A lot of negative gamma did come into the tape as well, but if you actually look at the scale, it's slightly smaller. So I would say that it's about the same. What actually happened was it was more of a positive gamma liquidation more than anything else. That being said, I am constructively bullish around the 49.45 area, constructively bearish below here, especially if we pass this significant gamma node right here. This probably looks like 49.20. We get below that and things really start getting ugly, we can then look towards the 48.50 level. But again, bearish below this line, bullish above. That's my take at the moment. Now, looking at seasonality, well, it looks like we're probably going to go and test this peak tomorrow or Friday. We are on the up and up. Dips getting bought by these dip buyers. And well, we're sort of back to regularly scheduled programming. Maybe we actually do just follow the seasonal trend. We did diverge right here, mean reverted, and now we're back on track. Maybe, just maybe, we actually do turn here at OPEX. And then maybe maybe take some of these lows right here, these lows right here, maybe even these. Historically, that's well within seasonality, even if we do go ahead and break these lows, as you can see by this chart right here. That being said, we are tracking seasonality very, very well, and we've had a stellar run February so far with all dips currently being bought. But like I said, we want to see follow through from all the buy side action we saw today. Now let's actually have a look at the charts. Mid caps, you can see that we are going to try and close the gap that's open right there. That being said, this does look healthy because we made a low, higher low, and then a higher low. And so we need to push above the high, close the gap, push above the high. That's going to be really, really constructive. Very similar situation for the S&P 600. Small caps, nothing has changed. Close the gap, push above the high, then go for these highs right there. Let's talk equal weight. Same thing, push above, close the gap, and then let's go for 164. Continue on that uptrend. We do want to see the broader market as a whole make new all-time highs. Uber Technologies up 15% after their Investor Day presentation. Crazy price action we're seeing. Definitely oversold. But I do think that Uber is still actually like fairly valued, even at this price right here. But very strong price action. I remember looking at this stock. We were looking at it here at like 57, and I was like, if we get a pullback to 50, we're going to definitely be buying. And that just never came. But I do own quite a lot of this stock in my ETF only portfolio. 7 to 8% I have exposure to Uber in quite a number of ETFs, especially in my tech ETF. It's very large exposure to Uber. But yeah, great price action. You don't want to get in front of this. But this is why Uber absolutely soared today, is because they said gross booking growth over the next 3 years, mid to high teens, 30% to 40% compounded annual growth rate for their EBITDA. And then look at their free cash flow as a percentage of adjusted EBITDA. They're looking at really expanding margins over the next 3 years. So we got top line growth, bottom line growth, margin expansion. That's actually what you want to see as an investor. That's why Uber is soaring. Something I also wanted to add, that Uber got added into the S&P 500 in October. And generally speaking, stocks that get added to the S&P 500 is actually very, very positive in the long run. Many people think it's a negative. It's actually not, while deletions have a negative impact. And also some more stats here. Stocks that split tend to beat the index. So if you see stocks that are splitting stocks, they generally beat the index. If they get added to the S&P 500, they do very, very well as well. And deletions, you don't really want that. So when your stock does get added to the S&P 500, you want to ensure it's growing earnings to stay there. Because once it gets added, it can be removed very, very quickly. It can float in and out. You don't really want that. You want a company that gets in there, stays in there. Now let's look at Bitcoin. Bitcoin is absolutely rallying. It's gone ahead, broken the highs. This right here was the Bitcoin ETFs coming to market. We are well above that. We're breaking above the 50,000 level, 51,000, very close to 52,000. And this looks very, very strong. Those are strong candles, strong daily candles, by the way. I wouldn't fight this trend at all. If you are looking for pullbacks, look at this 46,000 range, maybe even this 48,000 range, but very strong price action on Bitcoin. And I think I have a weekly chart right here. Man, based on this weekly chart, it's cleared a lot of major obstacles. And I think it might even just go for all-time highs at this pace right here. I mean, there's not a lot of volume on the way up right here. And listen, if this does go and break this all-time high, that's actually going to be super, super bullish for crypto, altcoins, everything. under the crypto space. Gold, and yeah, gold has actually done really nothing since 2020. I mean, you could have said that 3 months ago, the same for stocks, but stocks are making new all-time highs. Gold, yes, once, but we are actually trending down ever since that day. And the truth is, there's just no real demand for gold apart from central banks. I think a lot of people just prefer equities, prefer bonds, prefer Bitcoin over gold right now. The only people really buying gold is central banks. However, gold is underallocated across all portfolios, fund managers, retails, institutions, the likes of everybody. And that could be a bullish sign, but we've heard that data point for the better part of like 9 months, and gold hasn't really gone anywhere in that time period. That being said, am I bullish gold? I do own a very small amount of gold, and I do think we see 2400 sometime this year, but there are better places to put your money for outsized returns. Looking at crude, and crude's finding resistance here at this 78 level. I thought we were going to see $80 oil. Apparently not, but we could go up. This doesn't look like bullish price action, doesn't look like bearish price action. I think the market is just trying to like figure out what's going on in the Middle East, what's going on with supply issues and so forth. Oxy did release its earnings, very average earnings. There wasn't much to go on there. They beat on both ends, top line and bottom line, but the market reaction probably had it priced in. Now looking at Apple looks sick. This, in a day that's very positive, Apple's down 0.5%, really weighing on the tech sector. This is kind of crazy price action. You could see a high, lower high, lower high, and we actually made a lower low right here. And now we're moving down after making this higher low. Not constructive for Apple right here. And listen, if we go ahead and break these lows we're seeing right here, we're looking at this 165 region for Apple right here in terms of the next support zone. Realistically, that is the next support zone, this 155, because this right here, that's going to act as support. This is the next line. So Apple not in a good position. Buyers need to step in here, and buyers need to step in there aggressively to take this higher, but it's just not growing as a company the way you would like it to grow. But if the price does get lower, Apple do a ton of buybacks. They'll be buying back a lot more of their stock. Data in the next couple of days, guys. We have retail sales, that's the big one, and then we have PPI. So those two things are going to really affect price action over the next few days. I'm really keen to see what PPI comes in. If PPI comes in cool, that's going to be very bullish for the market, but I think it's going to come in very similar to what CPI came in as well. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell. Cheers.